The latest drama in the markets has me thinking defensive. What would I want to own in a recession? I'm Nick, and this is the Dividend Growth Income channel. And in today's video, I'll be highlighting 3 dividend growth stocks that should hold up well during a recession and make great additions to a dividend growth portfolio. In times like these, it's crucial to focus on stability. When markets dip, you want capital preservation. And as a dividend investor, dividend safety is a must. So let's dive into these picks and see how they stack up in uncertain times. And be sure to stick around until the end of the video. I do have one additional pick that I think investors should consider in a down market. Now, if you're into dividend investing and all things finance, kindly drop a like on this video, subscribe, and hit the notification bell to stay up on our latest videos. And with that said, let's dive in. So I'm recording this on April 3rd, the first market day after the new Trump tariffs went into effect, and let me tell you, the markets went into straight up panic mode. The S&P 500 dropped nearly 5%. But folks, let me stress, this is not the time for long-term investors to panic. This is the time to stay the course. Keep dollar cost averaging, keep investing in quality companies. I buy on the way down, and I'm going to buy again on the way back up. The market might be reacting with fear, but there are companies out there that didn't drop at all, and in fact saw their share price go up as investors move into defensive stocks. For the first stock that I'm going to cover today, the price went up 1.7%. The second stock went up 2.9%. And the final stock, it managed to stay mostly flat, about 0.2%. And remember, the S&P dropped 5% just on this day. You buy these stocks for stability and the reliability they provide. They may not necessarily outperform the broader market in normal times, but they'll help minimize the overall drop in your own portfolio. As investors get closer to retirement and needing their investments, it also makes sense to go heavier on this type of investment. The first stock we're covering today is Procter Gamble, ticker PG. This is a name you've probably heard of. In a recession, consumers were always going to need the basics, right? Things like toothpaste, toilet paper, and laundry detergent. Procter & Gamble owns some of the world's most recognizable brands, including Tide, Pampers, and Gillette. These products aren't going anywhere, and neither is the demand for them. This gives Procter & Gamble the ability to continue generating revenue even when the economy takes a hit. Looking back at the last recession, the S&P 500 dropped 55% from 2007 through 2009, while Procter & Gamble only saw a 36% negative return. Not as bad, right? Now let's fast forward to the COVID crash. Like most stocks, Procter & Gamble did see a price drop, but it was really a minor blip on the radar, and it recovered quickly within a month or two. And who could forget the toilet paper craze during that time? Well, Procter & Gamble owns the household brand Charmin, so that might have helped them a little bit. And in the last 10 years, Procter & Gamble has delivered a 169% total return, which is solid for a defensive stock, even comparable to the 210% return from the S&P 500. Right now, Procter & Gamble is trading at a forward PE of 23.9, right in line with its 5-year average, which suggests the stock is fairly valued. Yes, 24 is a bit of a premium, but this is a premium company. And as for the dividend, Procter & Gamble is yielding 2.38%, also right in line with the 5-year average. So fairly valued by dividend yield theory. So this is a stock that's not on sale, but it's also hard to find the stock at a discount. And for good reason. This is one of the safest dividends out there with the Simply Safe Dividend Safety Score of 99. Things would have to go really, really bad. Think apocalypse level bad for Procter & Gamble to be cutting its dividend. And payout ratios are really healthy too, with about 57% of forward earnings, 59% of forward free cash flow going to the dividend. Free cash flow per share has grown from $3.91 in 2015 to $6.87 per share today. Solid growth by any measure. This consistency is why Procter & Gamble has been able to grow its dividend for 68 years straight. The 5-year average annual dividend growth rate is around 6%, and their latest raise last April came in at 7%. We're also expecting the next dividend raise any day now, with an estimated ex-dividend date of April 21st, so mark those calendars. Operating margins are holding steady at 25%. Free cash flow margin is at 19%. Nice, consistent, and stable. To top it off, they manage their debt extremely well, the 1.04 net debt to EBITDA and a 34% net debt to capital ratio. I think that's very reasonable. Procter & Gamble is a staple in my own portfolio, and with things looking a bit shaky in the market right now, I'm certainly glad I made this decision. But what do you think? Let me know down in the comments. The next stock I want to own in a recession is Johnson & Johnson, ticker J&J. one of the largest pharmaceutical companies in the world, also a major player in medical devices. And the thing is, the need for their products doesn't go away just because there's a recession. People still need medicine, surgeries still happen, healthcare continues, making J&J a solid defensive pick. And one thing I really like about J&J is this diversified portfolio. It's not overly dependent on a single drug or product, which makes it one of the least volatile pharmaceutical stocks out there. And it also is just one of a handful of companies with a AAA credit rating. It's a distinction that speaks volumes about its financial strength and resilience. Let's talk performance in downturns. Between 2007 and 2009, the S&P 500 dropped by 55%, but Johnson & Johnson only slid 27%. That's pretty impressive. During the 2020 pandemic, the stock dipped just like everything else, but bounced back quick. This is a battle-tested company. Now, I'll be the first to admit J&J's performance over the last few years is a bit lackluster, but that could actually mean opportunity. Over the last 10 years, J&J has returned 106%, about half of the S&P 500. But again, we're not necessarily looking to beat the market here. We're looking for reliable and defensive stocks that are going to hold up during recessions. Let's look at valuation. J&J has a forward PE of 15.1, slightly below a 5-year average of 16.3, putting it on the lower end of fair value. And really, a PE of 15 in healthcare is pretty reasonable. Now, by dividend yield theory, J&J looks potentially undervalued. Shares are currently yielding 3.1% compared to the 5-year average of 2.74%. This suggests this could be a decent time to start a position or add to an existing one. Simply Safe Dividends gives Johnson & Johnson a dividend safety score of 99, about as safe as it gets. And just yesterday, that score was reaffirmed, even after J&J lost a key court ruling to its talc powder lawsuits. They were unable to resolve tens of thousands of cancer-related claims via bankruptcy, but despite that, the dividend outlook remains strong. Their dividend payout ratios back that up: 47% of forward earnings, 53% of forward free cash flow. That's very manageable. Free cash flow per share has also been growing steadily from $5.81 in 2015 to $9.27 today. And that kind of growth supports consistent dividend increases, which J&J has delivered for 62 consecutive years. And get this, they've gone 109 years without reducing their dividend. Incredible. The dividend is growing at an average rate just over 5% per year. Pretty run-of-the-mill average. On the profitability side, we're seeing a 25% operating margin, which has been very stable in the mid-20s range. Free cash flow margin is at 21%, very strong. And the balance sheet is rock solid. Net debt to EBITDA is just 0.41. Net debt to capital is at 16%. Like I said earlier, they don't have a AAA credit rating for no reason, for nothing. So all in all, I think it makes a ton of sense for long-term dividend investors to own a stock like Johnson & Johnson, especially when facing uncertain times. And so today, Friday, April 4th, as I'm wrapping this video up, the market dropped another 5%, 5.5%. So yeah, these are some pretty crazy times, and all of the stocks I'm highlighting today actually fell today. Well, they didn't yesterday, while the S&P was down about 8% over the last couple days. So there's a lot of uncertainty in the markets right now. A lot of panicking, but my suggestion is to just hold on tight, keep doing what you're doing. And our third stock today I want to own in a recession is Costco, ticker COST. This warehouse retail giant thrives during recessions because people start looking for ways to stretch their dollars further, and buying in bulk is a great way to save some cash. Costco has built a loyal customer base with millions of members who keep coming back for those deals. Plus, they have a subscription model, meaning their membership fees provide a steady stream of income, even if people aren't spending as much on other items. That's a huge benefit when other retailers might be struggling. Their strong business model, high-quality products, and loyal customer base make Costco an ideal stock to own in a recession. From 2007 to 2009, when the S&P 500 was down 55% over that 2-year stretch, Costco dropped only 38%. And in the 2020 COVID crash, Costco didn't skip a beat. It saw no drop. It just continued to perform, and retailers did very well in that period of time. And for a retailer, this company has been smashing the broader market with a 671% total return over the last 10 years. Costco is a premium stock, and it trades at a premium PE. It's gone up huge. The current PE of 51.3 is far above the 5-year average of 37.5. And the dividend yield of 0.48% is quite a drop from its 5-year average dividend yield of 0.72%. This is an expensive stock, there's no question about it. I would also say not owning this stock is perhaps my single biggest regret as a dividend growth investor. And I know that 0.5% yield is going to turn off a lot of dividend investors, but hear me out. They randomly pay huge special dividends every few years, which is a nice bonus. They did it in 2023 for $15 per share. In 2020, I think they made for $11 per share. In 2017, it was like $7 per share. So they're due to do another one of these here in another year or so. And the dividend is safe. With Simply Safe Dividends, the safety score is 99, making the dividend cut highly unlikely. The payout ratio is just 25% of earnings, 22% of forward free cash flow, and this gives them plenty of room to grow. Costco has 20 years of consecutive dividend payments, and the 5-year dividend growth rate is 12% annually. So over time, if you're patient, you'll end up with a very attractive yield on cost. The margins aren't huge, just 4% of operating margin, 5% free cash flow margin, but this is unfortunately very typical for retail. What's not typical is how little debt they carry. Costco actually has more cash than debt on their balance sheet, very rare for retailer. So if Costco feels too pricey, I totally get it. It felt that way for me too. You might want to look at alternatives like Kroger, ticker KR, or Walmart, ticker WMT. Now both are a bit overvalued, but not at Costco's 50 plus PE level. But still, all those stocks, these retailers that people are going to go to no matter what the economy is doing, I think they make good defensive plays for the recession. That said, Costco shines above the rest. This is a stock I would want to own for the long haul. And not for that bonus pick. If you watched my videos before, this isn't going to be a surprise, but I think SCHD, the ETF, is an excellent investment choice for defensive dividend growth investors. The algorithm behind SCHD, the Dow Jones US 100 Index, selects high-quality companies each year, giving investors a reliable way to get dividend stability, above-average yield, and double-digit dividend growth, all with an ultra-low expense ratio of just 0.06%. It's a fantastic low-maintenance option if you want to build a recession-resistant dividend income portfolio without having to pick individual stocks. I am personally buying into this right now. And here are the top 10 holdings right now that are in SCHD, and this makes up 40% of their fund. You have ConocoPhillips in the top spot at 4.69%, Chevron Corp at 4.42%, Verizon at 4.4%, Coca-Cola at 4%. Then we have Bristol Myers Squibb, Altria Group, AbbVie, PepsiCo, Amgen, and Cisco Systems. That's the top 10. SCHD has become very energy heavy with the latest reconstitution, but like I mentioned, reconstitution happens every year, so it's always in flux. Now, if you want to see how my own portfolio has held up over the last month, go ahead and click into this next video where I'll share my dividend income and what I've been buying in my public taxable dividend growth income portfolio. Thanks so much for sticking around, and until next time, my friends, keep investing.